Welcome back to the Wall Street Podcast. Today we're taking a deep dive into a Goldman Sachs research report on PDD Holdings. That's ticker PDD. It was published August 26, 2025. The title is PDD Holdings, PDD 2Q25 Review. Profit beat from lower S&M and one-offs. Continued reinvestments yet to benefit from easier base from 3Q. Buy. So quite a mouthful, but it really digs into PDD's second quarter 2025 results, their investment plans domestically and for Temu, and Goldman's updated view.
Yes, it's an interesting analysis, really looking at how PDD is juggling, current results with some pretty aggressive long-term investments. The report points out that their Q2 profits actually came in higher than expected.
Higher? How so?
Well, it seems it was mainly down to lower selling and marketing costs, S&M as they call it, and also a significant bump in interest and investment income in that quarter.
Okay, a profit beat. But didn't management sound quite cautious? I recall them really emphasizing ongoing pretty large reinvestments back into the platform, that huge RMB 100 billion plan for users and merchants over 3 years, for instance.
That's right. They definitely stuck to that message. Continued heavy investment. And that commentary, likely contributed to why the share price didn't jump dramatically right after the results. It was a bit muted.
So balancing act then. What about the specifics? Domestic versus international?
Domestically, the picture seems to be improving. GMV profitability showed some gains. Goldman actually tweaked their forecasts there, looking a bit more positive now. On the Temu side, Q2 investment was actually less than anticipated.
Ooh, why was that?
Seems partly because they pulled back a bit on marketing in the U.S. This was around the time those tariff uncertainties were peaking. And Temu's model itself is shifting, moving away from the fully entrusted approach.
Shifting how?
Towards what they call semi-entrusted and also using more third-party local merchants. These models generally mean a lower markup for Temu itself. Elsewhere, online marketing revenue grew about 13% year over year in Q2, and they expect that to stabilize. And domestically, Duoduo Grocery is set for more investment to sort of sharpen its edge.
Right. This brings up a key question then. How did PDD actually beat on profit in Q2 if they're so focused on heavy reinvestment? Seems like conflicting signals.
Yeah, it does look that way initially, but the Q2 beat seems tied to very specific, perhaps temporary factors. Like we mentioned, the pullback in Temu U.S. marketing spend during that tariff uncertainty. That saved some money in the short term. And their interest and investment income was unusually high in Q2. Jumped to RMB 10 billion from just RMB 12.2 billion the quarter before.
Ah, so one-offs played a big role.
Exactly. So you had this temporary financial boost happening while management was consistently reinforcing the long-term strategy. Keep investing heavily in the ecosystem, like that RMB 100 billion plan. It's about prioritizing long-term growth over maximizing profit every single quarter.
Okay, that clarifies the profit beat. Now let's go back to Temu's strategy. You mentioned the shift away from the fully entrusted model. What are the key parts of this evolution, and what does it mean for Temu getting profitable internationally?
So the lower Q2 spending, as we said, linked partly to U.S. marketing caution. The core shift is moving from PDD managing nearly the whole process for merchants to models where merchants handle more themselves, the semi-entrusted model, or working with local third-party sellers directly. This inherently means Temu takes a smaller slice of the revenue, a lower markup.
Which sounds like it could hurt profitability.
In terms of margin percentage, yes. But Goldman Sachs actually expects Temu's overall profitability to improve. They're forecasting narrower losses for the full fiscal year 2025. The idea is that as maybe geopolitical issues ease up and this new model finds its footing, the path to profitability gets clearer, even with lower per item margins. They do expect marketing spend to ramp up again, though.
Interesting dynamics.
Yeah.
Okay, final piece, the valuation. Goldman Sachs has a buy rating, and they bumped their 12-month price target up to US $148. What's driving that confidence?
Several things feed into that buy rating and the higher target. First, those early signs that domestic profit is stabilizing. That provides a base. Second, there's maybe a bit more clarity now on Temu's U.S. operations despite the model shift. And third, valuation. Goldman sees the stock as attractively priced. It's trading around 12 times their estimated 2025-26 average earnings.
And how does that compare?
Well, they contrast that with the median for the China internet sector, which is closer to 18 times earnings, so a noticeable discount. Plus, they highlight PDD's underlying strengths. Its ad technology is quite sophisticated, and it leverages China's very cost-competitive supply chains. The expectation is that as earnings growth really starts to pick up speed in the second half of 2025, what they call the inflection, the stock has significant potential to be re-rated higher.
We've covered the report's findings, the strategy, the valuation, but let's bring it back to the everyday person. For you listening, how might PDD's strategy actually affect you?
Well, think about your own shopping. PDD is pouring money back into its platforms, both Pinduoduo domestically and Temu internationally. This intense competition in e-commerce, the efforts to improve Duoduo Grocery, expanding Temu, it's all ultimately aimed at winning and keeping customers. So for you, that likely means more product choices, potentially better services, maybe faster grocery delivery, for example, and continued pressure on prices. When these giants fight for market share, consumers often end up getting, better deals and services.
So this deep dive really highlights PDD's complex balancing act, managing today's numbers while investing heavily for tomorrow's growth. For you, the investor, understanding these internal strategies like the Temu model shift and the external pressures like competition and tariffs is absolutely key to gauging the potential risks and rewards ahead. It helps you see where the e-commerce battleground might shift next.